Hello Rogers TV, welcome to Smart Money, the show where we teach you how to make the best use of your money to reach your goals in the most efficient way possible. Consider me your financial GPS. I'm your host and wealth advisor, Mitchell Huynh. This week we discuss how to use RESPs to save for your children's education, as well as tips on home buying. RESP, which stands for Registered Educational Savings Plan, is a specialized account that the Government of Canada put in place to help you save money specifically for your children's education. I love this account. Why, you ask? Because the government gives you free money in this account to help pay for your children's education. Anytime the government gives us free money, we definitely need to make the most of it. Considering that the average cost of university tuition and boarding for an undergrad in Ontario is approximately $15,000 annually, that is a total of $60,000 over a 4-year bachelor's degree. Tuition is generally rising year over year, not to mention inflation. If your child is 5 years old today, 12 years later when your child is 17, you may easily be looking at a bill of $25,000 a year for tuition and boarding, making the 4-year total a massive $100,000. So let's talk about saving money today and how we can get access to that free money from the government. One of the main benefits of the RESP account is the Federal Canadian Educational Savings Grant, the CESG. This grant is 20% of any eligible contributions or deposits in an RESP account. 20% of a $1,000 contribution is $200. So now you'll have an extra $200 in the account courtesy of the Canadian government. This basically gives you an extra 20% one-time return on your contributions. So why don't people put even more money in to be eligible for more grant money from the government? Because there is a restriction. The government will provide a 20% grant up to a maximum of $500 per year of grant money. That means to maximize the grant, you will need to contribute to the RESP $2,500 annually, approximately $208 monthly. The maximum amount of grant per child is $7,200 for their lifetime. If you contribute $2,500 every year, you will hit the maximum grant level in the 15th year, and no more grants will be paid to the beneficiary. Also, the government provides additional benefits for lower earning families. Families with net income between $42,700 and $85,400 are eligible for an extra 10% grant on the first $500 of contribution each year, for a total of $50 per year. Families with a net income of $42,700 or less are eligible for an extra 20% grant on the first $500 of contribution each year, for a total of $100 per year. So, if your family falls between these brackets, be sure to apply for the additional grants. With the cost of tuition increasing, every dollar counts. There are a few things you need to remember when opening and using the RESP account. First, the child must have a SIN number and be a Canadian resident to have an RESP and receive the grants. Second, the RESP is similar to a TFSA in that there is no tax receipt issued for the contribution, and any income you make in the account through investments is not taxable. Third, income withdrawals are taxed in the hands of the student, and contributions, which are the original amounts you deposited to the RESP, can be withdrawn tax-free. Fourth, the last year a child can receive a grant is the year they turn 17, so it is not too late to start if you have older children. And lastly, the maximum amount of lifetime contributions that can be made to a child's RESP is $50,000. When withdrawing money, all you have to do is provide proof of enrollment. Check with your financial institution for their proof of enrollment criteria. The government has provided a verification of enrollment form, which most educational institutions will fill out for you. You don't have to provide receipts or any other kind of justification for your payment request. You always want to ask for more rather than less. Withdrawing from an RESP is not as convenient as withdrawing from your checking account. So don't be afraid to ask for enough to tide your student over for a while. You don't have to give all the money to the student right away when you withdraw it. Most students are not as financially savvy as you are and might benefit from getting a regular payment rather than a lump sum at the beginning of the semester. The money in the RESP is your money until you give it to the student. All withdrawals of contributions from an RESP account can be sent either to you, the subscriber, or the student, the beneficiary. However, if you request a withdrawal of the accumulated income in the form of an EAP, which is Educational Assistance Payment, the money has to be sent to the student. And only the subscriber, which is you, can request payments. The student, who is the beneficiary of the RESP account, has no control over the money. They cannot request payments, only the subscriber. To save on your child paying taxes specifically, you need to specify if the withdrawal is going to be made from the contributions, non-contributions, or both. There are two parts of an RESP account. Contribution amount, so this is the total amount of all your contributions to the account. Accumulated income, this is all the money in the RESP which is not contributions. RESP grants, capital gains, interest payments, dividends are all included in the accumulated income portion. When planning the withdrawals, try to withdraw as much accumulated income money as you can tax-free. For example, when the student first starts school, they will have just completed a short summer, so they probably won't have much income for the year. During years where your child is not working or has an annual income below $11,000, that might be a good time to maximize payments from the accumulated income portion of the account. This is also known as the Educational Assistant Payment. In years where your child is working part-time after classes or during summer and will make more than the personal income threshold of approximately $11,000, the majority of the withdrawal should be taken as a contribution, as that portion is not taxable. And those are the basics of the RESP. As the cost of tuition increases year over year, you will want to put aside more money. You never want to over-contribute to the RESP, just enough to get the government matching, as there are more efficient ways and flexible ways to save for your children's education. As we spoke about before, our RESPs are to be used only for education. Withdrawing the money for anything else is a tiresome process with many government regulations. We will speak more about these other strategies in our later episodes regarding advanced planning. Next, we move on to home buying. Many of you will be looking to buy or sell your home sometime this summer. Buying a home can be a daunting task. It's hard to know whether you're ready to buy a home. The shift from renting or living at home to owning your first property can be intimidating. We will discuss a few issues you should look into, such as your credit score, getting a mortgage pre-approval, the down payment, and the value of a good realtor. Generally, one of the first things people think about when buying a home is the mortgage. When it comes to the mortgage, the very first thing you need to do before looking for a home is getting a pre-approval from the bank. A pre-approval is a written agreement with the bank that they will lend you a certain predetermined maximum amount of mortgage at a guaranteed interest rate. This interest rate is locked in for the next 90 days. This doesn't mean that you have to take this rate or stay with this bank. However, it means that worst come to worst, that this bank will guarantee you that amount at that rate. So, if you find a better rate elsewhere, feel free to finalize your mortgage there. The pre-approval's main purpose is to let you know what value of home you can buy. This allows you to budget the purchase of your home. So if you are pre-approved for a $400,000 mortgage and you want to purchase a $500,000 home, you will need to have a $100,000 down payment. A good rule of thumb is to take your combined gross income and multiply that by 4.5. So if you are making a combined income of $80,000 in a two-person household, which is $40,000 each person, then the maximum amount of mortgage you can qualify for is approximately $360,000. Things you should consider when it comes to your mortgage are obviously the rate, and secondly, repayment options. All banks have relatively the same rates when it comes to mortgages, as all banks are offered the same borrowing rates from the Bank of Canada. Whether you get 2.59 or 2.56 for a 5-year fixed is almost negligible. You're looking at a difference of several dollars each month. What is more important is the fine print, the penalty when breaking the mortgage, the repayment terms. The more flexible your mortgage, the better. Having the option to double up the payments whenever you want, putting a lump sum of 10 to 15% of the original amount, or increasing the regular payments by 20% will have a large effect on the cost of interest. This is because all the extra payments you make on top of the regular monthly or bi-weekly payments will go directly towards repaying the principal amount rather than the interest. A lot of people debate between getting a fixed mortgage, which is one in which the rate is fixed for a set number of years, or a variable mortgage, one in which the rate is based on the prime rate less a discount. Normally, you will see variable rates as prime minus a number. For example, prime minus 0.7. That means if the prime rate is 2.7, your mortgage rate will be 2.7 minus 0.7, making your mortgage rate 2%, which is significantly lower than the fixed rate. The one drawback to this type of mortgage is that as the prime rate increases or decreases, your mortgage rate will fluctuate accordingly. However, the prime rate is not adjusted often, so when the prime rate is increased, it is a minimal increase. Therefore, in this low-rate interest environment, a variable rate mortgage will work towards your benefit. The second thing you should consider when applying for a mortgage is your credit score, which is also known as your beacon score. Your credit score will dictate whether you will qualify for a mortgage from an A lender. An A lender is one of the big banks. They generally have better rates and better repayment options than a B lender. B lenders are smaller financial institutions which charge a higher interest rate and have higher mortgage break penalties, as they tend to insure higher risk individuals. So how can you raise your credit score and become a low-risk borrower? Quite simply, always repay any of your debts on time, whether it's a Visa card, a line of credit, or a phone bill. By making sure at least you make the minimum payments, your credit score will not be affected. By continuing to pay the full balance owing and never maxing out your credit cards or lines of credits, you can actually raise your credit score. If your credit limit is $10,000, never borrow more than $7,500. If you max out your credit card or line of credit, the system sees this as poor cash flow management, which makes you a higher risk borrower, which then lowers your credit score. A lenders cannot approve you for a mortgage if your credit score is below 650. So if you're planning on purchasing a home in a year, make sure your credit score is strong. The third thing you should consider is your down payment. As home values keep appreciating, it is often hard to keep up with your savings. Having a sizable down payment requires planning ahead. Best case scenario for a down payment is 20% of the purchase price. This means if you are purchasing a home for $500,000, you will need a down payment of $100,000. Having a 20% down payment means you avoid the high ratio mortgage insurance from CMHC, which is Canada Mortgage and Housing Corporation. A high ratio mortgage is any mortgage with less than 20% down payment. This insurance amount is added to your mortgage amount. It is generally several points on the mortgage amount. 20% is sometimes hard to accumulate for a down payment. The good news is, for first-time home buyers, the government allows you to beef up your down payment by drawing on your RRSPs. This is one of the few exceptions to drawing on your RRSPs tax-free. The only limits are you can withdraw only up to $25,000 for each homeowner, and you have to repay 1/15 of the amount to your RRSP account every year, or you'll be taxed on the outstanding amount as income. For example, if you withdrew the full $25,000, then every year for the next 15 years you will have to repay approximately $1,600 to your RRSPs. It is generally good practice to speak with a financial planner who can educate you on the amounts you will need to put aside every month to reach your down payment goals, according to your timeline, and how your cash flow will change once you are a homeowner. Remember, you can't enjoy life or work towards your other goals if every cent you make is going towards paying for your home. Other factors you should consider are finding a realtor. Look in the phone book, online, or ask friends. Ask the realtor for references, experience, and success rates, and be sure you're comfortable with the agent. Your realtor should be well informed about every aspect of where you're looking for a home, such as attributes of the neighborhood, schools, and community groups, and have experience negotiating deals in your price range. Budget for extra expenses such as moving, new appliances, and utility hookups. Moving costs vary, but the average is about $500. Utility service charges for electricity and phone will total about $150 to $250. Add appraisal fees, title insurance, and service costs to your budget as well. Always prepare for closing costs. Generally, I recommend setting 3.5% of the house cost aside for closing costs, such as land transfer taxes. So if you're buying a $500,000 home, you should be setting aside $17,500, which is 3.5% of the purchase price. And note, if you're a first-time home buyer, you may be eligible for a land transfer tax rebate. Avoid hidden costs with a home inspection. It's worth approximately the $350 to get the house checked out before you make the commitment. Your real estate agent will advise you on how to make your offer conditional on the inspection. When viewing the home with your real estate agent, ask as many questions as possible. The selling agent is not legally required to tell you everything that is wrong with the home. They only have to disclose information if you ask them. So make sure you ask if anything seems out of place. I've heard a story of a couple who purchased a home in which one wall of the room was newly painted. Unfortunately for them, they didn't ask why. When it rained a few months later, the couple discovered the wall had a leak, and the paint was to cover it up, so they ended up spending an extra $20,000 to fix it. So always ask, ask, ask. By asking, you not only protect yourself as a buyer, you also lower the asking price. Since you have exposed areas in which you will need to spend money to fix up the home, that amount can be deducted from the purchase price if your realtor negotiates those terms for you. And lastly, and most importantly, keep your emotions in check when negotiating, because they can lead to impulse buying. So be prepared to walk away if a bidding war drives the house out of your price range. Next, we sit down with renowned brokerage owner and realtor Sam McDaddy to discuss the do's and don'ts of home buying and selling.